time now for top picks from our guest on Market Call, Keith Richards. Johnson & Johnson is the number one pick, a very familiar name to most North American investors, the pharmaceutical giant, ticker symbol J&J.
And they also make Band-Aids. So this is a stock that we are, we're looking at maybe a volatile summer. It seems to have started. We don't like technology. Did I mention that only 40 times so far in the show? I don't like technology. So I want anything but tech. So this is a stock that we recently bought. You can see why it's bouncing off of the support line. Where we think it'll go is just maybe 170, if we're lucky, 180. But we think it's a safe stock, and we'll trade it at the top of the range and hopefully not participate in the downside that the technology sector we perceive will have.
Okay, J&J, top pick number one. Number two, now Keith has said that he has a higher than typical balance in cash. This looks like a cash holding, the Horizons High Interest Savings ETF. Okay,
so yeah, we're pretty close to 30% cash right now. I think it's like 28 or so percent cash, and 20% is in this.
That is quite a looking graph. You were talking about this off air.
Yeah.
Describe this to us.
The Bart Simpson haircut. So this is basically what happens is it's invested in a few high interest savings accounts, just at different banks, and it, whatever the yield is these days, you can see yields have gone up over time, because right now they're paying probably closer to 5%. Back then it was probably paying closer to 1 or 2%, but it accumulates the interest and pays it out as a dividend or a distribution. Accumulates, pays it out. Accumulates, pays it out. So that's what's with the weird looking chart. Doesn't reinvest it. Just
do you have any idea what happened in March? Why did it spike down so much in March?
Honestly, I don't. That's probably that could just be a chart blurb.
Right.
So.
Okay, and what is the benefit of owning this one versus owning a GIC or having your money indeed in a high interest savings account?
Well, it's in shares, and I mean, for a retail investor, it might be better just to buy a high interest savings account. But we manage a lot of money, and we have to let's say that we're, I think, 8% or something cash outside of this, and let's say we want to add 10%. New stocks because we see positive developments on the market in a month or something. Well, that's great. Maybe we can just sell a few units of this and keep the rest. It's just, for us as an institution, it's an easier trade for us. That's all.
Okay. Top pick number three from Keith Richards is the Consumer Staples Fund, ticker symbol XLP in New York. That looks like a consumer staples ETF, correct?
That's right. Yeah, it's kind of the go-to. So it's got all your classic staples. I like to say staples are what you need and discretionary stocks are what you want, right? So during times of lower markets and maybe recession or whatever, people tend to still need to buy their toothpaste and toilet paper and food. So sideways, coming off that sideways thing, probably will get to the top of the range. That's the reason we own it. We don't expect giant returns, but we don't expect giant losses on it. And to us, because of what's going on with technology, we think we'd rather hide in an area like this.
Let's bring back that graph. What is it you like particularly about that graph? Is it the upward movement on the very recent upward movement we're seeing there?
Slightly higher low, and it's a fairly predictable lid. So I know exactly. I'm not drawing my lines great, but you get the picture. So we can call that $78 or something. I know where it's likely going, and I know where I want to sell. So to me, it's kind of a no-brainer. It's not a high beta stock, a sector, I should say. It tends to do well seasonally over the summer. It's coming off of a low level. We just think it's a good place to hide out in the summer, make a few percentage points.
And I'm assuming there's other consumer staples ETFs in the U.S. If so, why choose this? How do you make your choice when you decide you want exposure to consumer staples? How do you decide which ETF?
Well, two reasons. Because this is probably one of the most liquid ones,
right?
And also, it's the one we've always used in familiarity. We've traded this like many times over my career. I can't tell you how many times. Probably like 20, 30 times over my career.
Keith.
Welcome back to Market Call. Okay, it's time now for top picks. And we're kicking it off with Greg's first top pick, which is AltaGas. That is ALA on the Toronto Stock Exchange. Greg, tell us why you like this name.
Looking for quiet, not crowded, under the radar names. You know, they had a very strong Q1. They're showing progress in de-risking global exports. They're evaluating the next phase of growth via liquid petroleum gas in a partnership with VOPEC. They have very strong utility growth, low capital, high return midstream opportunities. All in, we see this name growing at around 9.5% and trading at a very reasonable 10.2%, pretty well being ignored by investors with a 5% dividend, near 5% dividend that we see growing reasonably 5% every year. So you get dividends, you get dividend growth, you get low valuation, and you get nice earnings per share growth at a below market multiple and a pretty ignored name.
Why? Why do you think it's been so ignored?
I think, you know, we talked about TransCanada, we talked about Enbridge, there's a lot of, we talked about Pembina. Higher interest rates have chased money away to a certain extent. And money has been chasing over the last 6 months into the FANGs, into the FANG catch-up. And it's ignored a lot of good names like this one. So there's opportunity in that.
Okay, next up, you have brought us a name that I would say is very much not ignored in the Canadian investing space, which is Rogers Communication, RCI.B on the Toronto Stock Exchange. What do you see as the drivers for growth here?
Lots of drama with this name.
So much drama.
So much drama, and a lot of people, are like, why this one? But, we do expect synergies from Shaw to accrue quickly. Wireless has been strong. I would say that this is not that crowded from an investment thesis. I mean, people have kind of ignored this name for a while due to all the drama. And look, it always comes down to price. And this one, I mean, you got TELUS trading at around 24 times. This one trading around 10.5 times with a robust 16% growth rate. So I think that there's, it comes to a point where it's just too cheap. We're always looking for how to get the most lift with the least amount of risk. And I think that this one fits that description here.
My producer wants me to ask what you make of the promises that they made after they acquired Shaw.
You know what? You mean in terms of lower pricing and that kind of thing? Well, I don't know if I'm going to comment on that one, but.
Okay, well, how about this? How about this? Not too long ago, there were reports that emerged that Larry Tannenbaum, who's the chair of MLSE, is looking to sell a portion of his stake in MLSE. How do you think, does that move the needle at all for Rogers Communication, or is that just a really cool story?
I think, I don't know that really moves the needle. It is a pretty cool story. I think the real story here is valuation, merger synergies, how much will they get? The first part is always the easiest. The last 20 or 30% of the merger synergies will be the hard stuff for them to accrue. But I think it's an ignored name. It's washed out. And I'm pretty sure if you buy this name, you're going to be in a good place in a year.
Okay, finally, let's go to Greg's final top pick for today, which is the BMO NASDAQ 100 equity hedged to Canadian dollar index ETF. That is a mouthful.
Yeah.
We were talking about it in the break.
Right.
You were saying this is essentially a currency hedged play on the FANG
The FANG stocks, yeah, that have got more to go. Now, look, Tesla, which is in there, is reasonable. Microsoft is reasonable. They were very cheap at the start of the year. Apple is expensive. But the other names like Google, Amazon, Meta, and even NVIDIA, even though I just said it's too expensive, on a PAG and looking out into 2025, still compelling. Lots of AI themes. Underneath the index, they're smaller holdings, but you've got lots of healthcare, innovative healthcare, industrials, and fast-growing stocks on the list. I think if you were people always ask me if I were just to put money in the market and go away for 100 years, what would be the one? This would be the index. This would be the index, and everybody knows that, or at least knew that 2 years ago, and everybody was in. And then, of course, it fell because it was over-owned. But it's a very exciting place to be.
But why not just own those stocks outright?
Oh, and we do. We very much do. And, you know, the last time I was on the show, Amazon was my favorite belle of the ball because it had been left out of the AI dance. And that was around, I think, 108, and now it's at 132. So what I'm always trying to do is get the most lift for the least amount of risk. And there's, you know, I like Amazon here, but I really like Google here, and I like Meta here too. And I thought that this was a good way to get at it. And I do feel that the U.S. or the Canadian dollar probably has more upside than down. So I would buy this in Canadian dollars this way. So
you own both this ETF as well as some individual stocks?
Oh, yeah, we own all those stocks. We own all those stocks in our portfolio. And, you know, the trick isn't owning them. The trick is at what levels do you buy them? I see. And you think now is an appropriate moment? Yeah.
Time now for top picks, and we're kicking it off with Quarterhill. That's QTRH on the TSX. Recently sold part of its portfolio recently, and now it's a pure play intelligent transportation systems company, correct?
Right. So they had two completely distinct business segments. They had the IP patent licensing business called Wyland, which they just sold finally a few weeks ago. So now they're a pure play intelligent transportation systems business. They're world leaders at electronic tolling in the U.S., based out of Texas, but they're also world leaders in weight and motion enforcement out of Saskatchewan, so where you can weigh vehicles as they're moving. Two segments that they, you know, they're leaders in the world, and they, as a pure play now, I think you're seeing a lot more institutional interest in the stock. They also have a huge backlog of projects, about $800 billion Canadian in projects that are being executed currently. You're going to see significantly improved margins in the next few quarters as some of these projects come out of implementation phase into a higher margin recurring revenue phase. So as a pure play, you know, you're starting to see some institutional buying. I think you're going to see a valuation bump up in the stock and significantly improved results going forward. Those are the catalysts that we see going forward. They're also adding some very strong, experienced members to the board. There's being a nice...
That's probably thanks to you, yeah?
Yeah, we've been shaking up the board with a few other shareholders, and you're starting to see some new directors being appointed that are really going to help the company going forward. So the past is the past, and onward and upward. Now, it's a great business segment. As you know, governments are looking for other revenue sources to pay for infrastructure, and so they're adding a lot more technology to highways and so on to capture more revenues, and they're benefiting from that.
Okay, next up we have Pollard Banknote. We talked about alcohol earlier. Now we're talking about gambling. Any other vices we want to discuss today? Let's stick with gambling.
Right. So it's not gambling.
No, that's true.
And we're actually anti-gambling. So as you know, Pollard is a world leader. They're the second biggest in the world in instant printed lottery tickets. There's only 3 players that do this in North America and Europe. So huge barriers to entry. And you know, all their clients are governments, states and provinces, and governments that you know, sell lottery tickets and use the money for, you know, society. So it's not gambling; it's more like entertainment. So what's happened here is that you've seen the stock come down due to much higher input costs from paper, ink, foil, which they weren't able to pass on to the states and provincial lotteries because they have fixed price contracts. But all those contracts are being renewed now at significantly higher prices. The business is still booming. I mean, it's been growing for decades and continues to grow. Pollard is also a leader in iLottery, or electronic lotteries, which are also growing as more states adopt electronic lottery systems. So you're going to see a significant improvement in margins over the next year or two, to the point where we'll probably see record results, and sales continue to grow organically. And so you're getting a stock that's trading at 9 times EBITDA, and then you saw Brookfield buy out one of their competitors at 14 times. So you're looking at a stock that has a potential to go well north of $40 a share.
Okay, let's get in the last one because we only have about a minute, but it's ag growth. Why do you like this name?
And we've talked about this one. It's a very good way to play the agricultural sector without taking commodity risk. They're, again, global leaders in the manufacture of grain handling and storage systems, and benefiting from countries like Brazil and India upgrading their farming infrastructure. The company generated record sales and EBITDA last year. They have a record backlog. They've increased their guidance again for this year. They're generating a lot of free cash flow, deleveraging quite quickly, which is another huge tailwind for the stock price. And it's still only even though it's doubled, we recommended a year ago, and it's gone up 48%. It's still only trading at 7 times EBITDA. And we think this company will probably end up being acquired by AGCO, one of the U.S. competitors, and could fetch as much as $90 a share, if it's acquired by a strategic buyer. So again, a great company in a great space, trading at a dirt cheap valuation, with a lot of tailwinds.
Welcome back to Market Call. Now it's time for everyone's favorite segment. It's John's top picks. Okay, we're kicking it off with the 12-month Treasury bill. You say you like this particularly for retirees.
Well, I like it for anyone right now, actually.
Anyone.
Because the Treasury bills, as I mentioned earlier, I had been buying the HISA ETFs, and they were yielding at the time around 4.8, 4.7, 4.8. The T-bills are yielding about 30 or 40 points below that. But you have the safety factor there that you don't necessarily have, and the HISA ETFs. So I'm not negative on the HISA ETFs. It's just I prefer the safety factor of when you're getting a nice yield of around 470, 480, something like that. That's very attractive for pretty. If you got $100,000 sitting in your account, you don't want to do it not doing nothing. And finally, after several years, we're getting some good yield. So I'm very happy going in and getting the safety and getting a nice yield for my clients on that. So that's the reason for that. The other problem, of course, for many retail investors is how do you buy these things?
Right.
And it's difficult to pull up a chart. It's difficult to do anything like that because these things don't trade. The bond desk is separate from the stock desk. There aren't market makers. There isn't a bond market. It all trades between institutions. So as a result, you're not seeing that much in terms of posted prices, and there's hundreds and hundreds of bonds. So it's sometimes difficult for the investor to buy them. I mean,
how do they?
They've got to have a pretty good relationship with their broker. That's going to be, if they're doing 5,000 or 10,000, nobody is interested. I go in because I'll buy several $1 million worth for my clients at once and then divide it all up as a block trade. It's more difficult for retail advisors.
Okay. Next up, we have the BMO Equal Weight Banks ETF. That's ZEB on the TSX.
Okay. I'm being very boring today. I use the
T-bills
and banks. Wow, exciting. Is that because I usually emphasize the ZWB, the covered calls, but the banks are down around 20+%. So I would rather take advantage of that. And at this point, I would be buying just the straight ZEB without the covered call because I want the growth at this point. And I'm not getting as much in terms of yield. I'm probably getting 3.5, 3 3/4 as opposed to 6. I don't care. I want the growth, and I think we're going to see that in the Canadian banks, despite the fact that they undoubtedly have some headwinds out there in terms of U.S. real estate because they're involved in that, commercial real estate. But, they've got all kinds of buffers in terms of capital, et cetera.
What about troubled loans here in Canada? Not to commercial in the commercial real estate space, but just
Personally, yeah, I was reading some statistics last week actually saying that the loan loss problems in Canada are actually pretty small. So, especially on mortgages, because again, in Canada you can't walk away from your mortgage. In the U.S. you can in some places, right? So they've always got you. So it's unlikely people are going to walk away. So they haven't really got as many as much of a default issue as they have in the U.S. So, and they're pretty low anyway. So.
Right. Finally, we have the Vanguard Large Cap Fund ETF. So that's VV. Can you explain what some of the components of this are?
It's the S&P 500.
Oh, there you go.
It's just the Vanguard version. They also have VOO, V-O-O, which is like basically identical to the Spider, S&P Spider.
Okay. So we're essentially buying
The S&P,
Okay.
plus another, depending upon what's in it, another 50 stocks. So it drills down a little bit into mid cap as opposed to just large cap. So that's why I use it, because it's got a little bit more diversification. So, but that ETF is in practically every, may not be in every account, but pretty much every client holds that.